The U.S. economy lost jobs in July. The stock market celebrated anyway. The same week, local schools and retailers cut staff. Wall Street's AI darlings posted some of their best days of the year. Both things happened. Only one story explains why, and it's not the one you'd guess. First, what the report actually said. Economists expected 83,000 new jobs in July. The economy lost 23,000 instead. And it wasn't a one-month fluke. May and June were quietly revised, down by a combined 103,000 jobs, meaning the labor market had already been weaker than reported for months. The headline unemployment rate actually ticked down from 4.2 to 4.1%. That sounds like good news, but it fell for the worst reason possible. 264,000 people stopped looking for work altogether. Participation dropped to 61.4%, a level outside the pandemic not seen since the 1970s. The losses weren't spread evenly. Local public schools cut 50,000 positions. Leisure and hospitality lost 40,000. Retail lost 19,000. Healthcare and construction were the rare bright spots, each adding jobs while everything around them shrank. Next, why Wall Street reacted the way it did. This report landed 1 week after the Fed's most divided vote in a decade. 3 regional presidents pushed to raise rates. The rest held steady, waiting on exactly this kind of data. A weak jobs report undercuts the case those 3 dissenters were making. Traders immediately pulled back their bets on a September hike, and the 10-year Treasury yield dropped. That's the mechanism worth understanding. When hiring cools, the case for higher rates gets harder to defend, and markets price that in almost immediately. Stocks opened higher. Not fireworks. The S&P rose 0.33%. The Dow barely moved, but the Nasdaq climbed nearly 1%, led by exactly the growth stocks that benefit most when rate hikes look less likely. This is the trade everyone jokes about, but nobody stops making. Bad news for workers reads as good news for a rate-sensitive stock market, at least until the bad news gets bad enough to actually hurt earnings. But that relief rally wasn't for everyone. Even among people who kept their jobs, the split was stark. Workers who switched jobs last month pocketed a 7% raise. Workers who stayed got 4.4%. Standing still is getting more expensive. 50,000 school employees and 40,000 hospitality workers do not own the stocks that rallied. A rate cut helps whoever holds the assets, not whoever just lost the paycheck. So here's the answer. The market wasn't celebrating the job losses. It was celebrating what the job losses do to Fed policy. Those are 2 very different audiences, cheering for 2 very different reasons. Meanwhile, a completely different economy was having its best week of the year. Tech didn't escape the report entirely. The information sector actually shed 9,000 jobs. That's a real number, just not the mass layoffs some headlines implied. But the same week, 5 AI-adjacent companies reported earnings or unveiled new products, and every single one of them beat. Atlassian, Cloudflare, Microchip, Marvell, and Micron all posted some of their biggest single-day stock moves of the year. Atlassian's quarter wasn't close. $1.87 in earnings against an expected $1.50. Revenue up 28%. Cloud revenue up 31%. The stock jumped 35%, its best day in years. Cloudflare didn't just beat. It raised its own bar. Full-year revenue guidance moved up to nearly $2.9 billion. Earnings guidance moved up too, all credited to AI-driven demand. The stock jumped 16%, and Palo Alto Networks rode the same wave, up 3%. The chick side told the same story. Microchip jumped on its own upbeat revenue forecast. Marvell spiked on new AI storage and networking hardware. Micron rose on a new partnership shipping the industry's first mass-produced next-generation SSD. Here's the honest read. None of those 5 moves were actually caused by the jobs report. Everyone had its own earnings beat or product launch behind it. What the jobs report did was clear a rate hike cloud out of the way right as they landed. put it all together, and one picture emerges. One economy runs on paychecks: teachers, retail clerks, hospitality workers, and it's visibly cooling. A second economy runs on AI infrastructure spending and enterprise software contracts, and it barely noticed. They share a stock ticker tape. They don't share a labor market. So that's the real story. Main Street's slowdown didn't cause the AI trade's best week. It just cleared the runway for it. Two economies moving in opposite directions, meeting for one afternoon on the same headline.